Yes, we have a rate movement. That's right, 25 basis points cut, bringing the cash rate down from 1.5% down to 1.25%. Now the question is that all? Is there more to come? Well, I'm going to answer that in a little bit later. They've led them as they've seen them, basically saying that, this is the biggest problem we've got around consumption. Because remember, consumption is 60% of GDP. So it goes on, despite this, the labour market is performing reasonably well. We've got, sort of unemployment around that 5%, and the underlying inflation, which is what they're trying to push up, has been lower than they expected at around 1.5% over the year to the March quarter, with pricing pressures subdued across the economy. The other important point there was in the context of falling house prices. So if we can see the bottom of the property market, then ultimately we might see a little bit more confidence in people starting to do their discretionary spending as well. So that's an important message. I'm now talking to the bankers here who are listening. If you don't pass on the full 25 basis points, then you are lying to your customers. And I mean that very directly. Okay, there is absolutely no justification at all in terms of not passing on the full rate cut. So it says here, so falling to historical low levels and equity prices have risen strongly. In addition, and this is for you bankers, pressure on short-term money markets has eased, reducing banks' funding costs. Banks' bill spreads are now at their lowest level since 2017. Although this has not flowed through in most advertised mortgage rates, that's why we're talking to you. You have absolutely no reason to not pass on the full 25 basis points cut to all mortgage holders. So I'm putting it on your banks. The pressure's there. So there is no justification not to pass on that full rate cut. No excuses. Okay, so now let's talk about future rate cuts. What Governor Lowe said in his speech last week around inflation. If they are going to go after inflation, they need to go after that by basically doing a second rate cut, which most economists are thinking is coming in August. And there's even some commentary around a third rate cut, which will take the cash rate below 1%. Now, there's a couple of challenges here, right, in getting the balance right. The first thing is, do we want to see the property market start to go crazy again? And the answer to that is absolutely not. So we want to see a steady level of growth. We don't want to see a boom bust type arrangement when it comes to property prices. If we do see further rate cuts throughout the course of the end of this year, and maybe even into the new year where we do get to below 1% cash rate, we're going to see the banks and APRA be very careful about their settings around making sure that borrowers can't borrow too much money. Important point is, how do we know that we're getting this consumption bounce? Okay, we talked before about, I said, don't panic about some of the economic results that you're going to see over the course of the next couple of months, because they are lagging indicators. The leading indicators that we really are interested in are these ones here. So I'm giving them to you.